Welcome back, everyone. Today's video, I decided to make on a topic that would be relevant for maybe the 370 odd days a year where people are talking about crashes or other extreme scenarios. So in this video, I'm going to discuss, do I plan for a market crash or massive inflation? I cover that too, but how I think about it. So there are always mega bulls out there, bulls, bears, mega bulls, perma bulls, all sorts of things out there. And that means that there's always someone saying market's going to crash X date, X soon. Sometimes very bright people, sometimes very emotional people. And the point is, there's always someone saying, this is just like 1999, this is just like 1929, this is just like some other period right before the market crashes. And in some ways, it often is. In many other ways, it's often not even close. But there's always someone saying it's going to crash soon. But the problem with betting on a crash or preparing for a crash is, well, firstly, it rarely proves to be accurate. Now, why is this? Because not only are you betting on things normally getting much worse, you're also betting on that fact in a swift period causing others to panic. So it's not as simple as market will crash because it's overvalued or market will crash because of some random reason, because it's this month of the year, because of anything. So you're really betting on a confluence of factors that you can't control. I mean, at least I can't control. So I just wanted to talk a little bit about why markets crash. Now, most of the time, markets crash when things are rapidly getting worse, and we saw that in March. Things went from, uh, well, at that point, they were in some instances okay to very bad very quickly. Now, other times it's just a recession. Well, I said just a recession, but a recession's bad. Well, recession's bad for stocks in general, but could be a recession, could be some global changing environment in a big way. That or some mania going parabolic and ending. And in that case, it's more of an instance of trying not to buy something late in a parabolic stage. But again, it's hard to see that sometimes when you're in it. And so I won't really talk too much about the late stage parabolic move, but in many other cases, the markets can go from very good to okay to bad, and there can often be a long decline in those instances, and that doesn't even necessarily cause a crash. So there's different ways to avoid different parts of these scenarios, but mainly try to buy things at prices that make sense and try not to buy when things are very good and you're hoping for best ever instances. On that note, I talk about the first thing that I guess I do to try and avoid being too concerned about the market crashing, and that is buying with a margin of safety. So ideally, I try to buy try to buy something that I could see going up more than 100%. Now, to boil this down to the simplest reason for why I do that, well, a market won't crash more than 100%, hopefully. Now, it can if you're using margin, which is one of the reasons why I don't. I personally don't feel comfortable with what I buy using margin. Now, some people do, and that can be fine as long as you know how to handle that and control your own risk. But the more elaborate reason for why I try to have a margin of safety is because personally, the next 3%, whenever I buy something, whenever I add to something, whatever, next 3% is gambling. I have no idea if it's going to go up 3% or down 3% next. That's realistically, some traders can say they do. Who knows? Maybe they do. But for me, it's gambling. The next 10 to 20% is often hoping. And I just say that because if you look at, let's say you're talking about some average stock in the market, could it go up 10%? Yeah. Could it go down 10%? Why not? And this could happen at any given time. So there are certain ways of mitigating some of the risk, but when you're talking about small moves, well, A, they don't really matter to me at least, and they can happen in either direction, and you can't really control too much about that. Another very valid point when it comes to buying companies and should you be worried about a crash, should you have to prepare for a crash or not, is to remember that these are companies which a few of which, let's go with a few of which actually make money. So you look at the long-term prospects for the company or short-term, medium-term, whatever you want to look at, and think the price I'm paying for this company, is it an okay price? Because if it's an okay price, for me, there's no need to buy. You can buy some if you absolutely want to or some other reason, but no need. If it's a good price, well, then you can consider buying. And if you look and you see, okay, this is a great price for this company, well, then do you really how much should you be concerned about if the market crashes and let's say if it falls another 50%? You thought it was a great price before. If the fundamentals don't change and it falls by another 50%, what kind of price is that? To me, that's potentially an amazing price. And this takes me to my next point. When I'm buying a company, and I've touched on this before, and many people advise the same thing, and it's how I live by. Try not to just buy the whole thing because, again, it could fall by 3% that day, could fall by another 10% that week, that month, heck, that day. You never know. So if it can fall more, it may. And if it may, well, if you have some cash, if you haven't bought your full allocation, well, you could buy some more. So for me, I just look, I have a number of ideas, and I buy my best ideas. And as they get cheaper, or as the thesis gets better, you never know, maybe they could stay at the same price and things could get much better. You can buy more. Now, this is similar to how I think about hedging for an inflationary shock. A lot of people will think, oh, if you want to hedge against inflation, you need XYZ commodity. Now, some people will say it's gold, some people will say it's oil or energy, some people will say it's copper. But in reality, many commodities perform well as inflation hedges. So for me, again, if I wanted to hedge a portfolio against a big inflationary shock, for example, I would have a number of ideas and, you know, buy the ones that make sense to me so that buy the best ideas. You have a number of ways to fight against inflation, hedge, whatever you want to call it, and you could do it in different ways. I mean, you could do it in a way that would do immensely well if there's the inflationary shock, and you could do it in a way where you just don't have to care about the inflationary shock. So basically, you just buy the best idea and have the inflation part of the thesis be a background noise. So you don't have to be like bet your entire thesis on inflation. You can bet your thesis on something else and have inflation be the free kicker, if you will. Now, while we're on the topic of big and violent moves, I just wanted to say a few things about inflation and cycles, particularly commodity cycles. So one of my investing frameworks is in the long term, the very long term, cash is a very bad investment. Why is this? Because it is on a steady and near constant path to zero. Of course, it never gets there, and realistically, we don't really notice this path in our day-to-day lives. But if you look at history, long-term history, medium-term history, it's often there. That said, when we're looking at commodity price charts and historical uh, cycles, I caution against using either fundamentals or charts of past cycles to say, to project or predict measured moves. Why is this? And it doesn't have to be a technical measured move. My meaning is that you can't necessarily look and say, okay, this did 5x last time or 3x last time, and so this cycle it's going to do 5x or 3x or whatever it is. Why is that? Well, every cycle works differently. It's a very historical and accurate saying that history rhymes, doesn't repeat, something like that. It's not me that came up with this, someone else, someone more practiced and smarter than I said it. I just remember it because it sounds good, even though I made it sound very bad right there. The point is, the cycle low is not a cycle low. If you look at the different factors regarding the prior bust, prior boom, what happened in the boom, what happened in the bust, where the inflation adjusted price was at the bottom last time, where it is this time, everything's different every time. And so you can't necessarily look at what happened last time as the direct mirror of what's going to happen this time. And back on the subject of crashes here. Crashes are rare. Since the 20s, there have been about 14 bear markets. Only seven of which, so half of which have gone beyond 30%. So first I want to compare that to the 8 bull markets, the 8 coincidental bull markets that have gone up over 100%. So already the risk reward there may be a bit skewed. Now, maybe not for some people. Maybe some people don't like risk. That's completely fair and completely possible. But my point there is you're more likely to go up 100% than down 30%. And I'll add to that that buying the top or buying the bottom is immensely unlikely. So you can dispute my math saying no one buys the bottom. That's true. No one sells the top. That's also true. And so point is, you still have very skewed risk rewards over the long term. Now, you can even skew that even more by simply having a bit more discipline if you're very concerned about buying the top and the market crashing. Well, if you only buy pullbacks, you're not going to buy the top. And if you look at historically, since the 1920s, there has been on average one 10% correction every 16 months. So next time there's a 10% correction, well, everyone is worried about, is this the crash? Odds being there's a 4 in 5 shot that this is not the crash, that this is just another 10% correction. So if odds are your favorite way to play, that might be a point to start looking at it. Now, is next time going to be the big one? Maybe. Again, remember, this is a video for the 395 days a year when people are talking about the crash. Will someone be watching this when the market is next crashing? Maybe. Will someone be watching this when they think the market is next crashing? Definitely. Point is, down 10% might be a decent spot to start buying. In conclusion, the market will definitely crash again, and at some point it's highly likely it will crash more than 50%. However, even if you waited 100% cash, you won't catch the bottom. That's just a 99.9% fact. Now, if you still are concerned about that, you feel free, absolutely free, to have some cash on the side or not invest in general. Now, that is entirely your prerogative and no one else's. So, but even if the market crashes, even if you're looking at it at the exact bottom with 100% cash, you will still be facing the question, buy now or wait until lower. And it won't be easy. Getting the answer and getting the answer right won't be easy. Now, personally, my attempt is going to be to try and more than double my money before the next crash. Now, if the market crashes tomorrow and it takes everything down, that will be a challenging goal to achieve. That being said, like I said before, if you buy stuff that you really like the price of, it doesn't matter if the market goes lower because you can just buy more. And so, which leads me to my last point. I personally never I try to never buy a stock because they are going up or because they are going down. And now some people might think, well, why not buy a stock that's gone down? That's not what I said. I never buy a stock because it's going down. Meaning, if there's stocks that are going down, A, you can wait, but B, it might be because there's a problem. It might not. It might be getting cheap. But never just buy a stock because it has fallen whatever percent and, oh, it must be cheap now, because it might not be. So never buy because it's going up or because it's going down. And that's all for today. Thanks everyone for watching. I hope I explained a little bit about why I'm not super concerned about when the market will next crash. Now, there are times where I might be more aggressive or more cautious, but overall, when the market crashing, not really the biggest deal to me. Now, that being said, if any of you have a good crash plan or want to tell me why it's something you think about all the time or not at all, I'd love to hear about that because I'm open to different ideas or strategies. And if you have a good one, I'd love to hear about it. So, with that, again, thanks for everyone who made it here. I hope you liked, and I will catch you next time. Until then, have a great day.